Markets are still near record highs despite a few down sessions recently, but are the conditions right for the rally to resume and continue? Joining us now to discuss is Jeff Evans, VP Director and Lead of Empirical Research and PM Support with TD Asset Management. Jeff, great to have you back on the program.
Great to be here. Thanks for having me on.
It's August. Volumes get a little thin. The trade can drift here or there. We have hit numerous new all-time highs this year. Looking forward, what can go right, what can go wrong?
So it's a great question with every time markets are at new highs, and then even more importantly, when you have valuations that are also starting to push into more elevated levels. It's certainly top of mind for a lot of people. What happens next? Where do we go from here? We did a little study in my team a couple weeks ago just to put some numbers around this, try to get a base case of what normally happens. We found some data on the S&P back to the 1930s all the way up until today, and did a really simple study where we went through and said every week if the S&P has hit a new all-time high, let's see what happens a year later. Is the market likely to be up, down, and you get a rough sense of the probabilities. It works out to about 70% of the time the market is up a year later. Of course, 30% of the time market will be flat or down. But those are still pretty good odds. And if the base case is 70% probability of going higher, usually means that investors should stay invested, ride out any short-term volatility. Over the longer term, the market tends to grind higher. Now, that said, there's a couple of things that are a little bit different this time that'll change those probabilities a little bit. Probably the most important is market concentration. What we've been seeing over the last couple of years is the large 10 stocks, largely the tech stocks, accounting for a greater and greater part of the S&P 500. That's up to almost 40% today. In fact, might even be a little bit more than that last time I checked. And so you're in a situation where if something goes wrong with one of those companies, if they have one little operational blip, a misstep, a miscommunication, they have a disproportionate impact on the index in a way they didn't have 5 or 10 years ago. You have to go back to the 1930s to find a period where the market was as concentrated as it is today. And what that means is, unfortunately, there's always a possibility that a company can have a negative quarter or something goes wrong. And so if we're thinking about the base case, maybe it's more like a 60% chance the market's up a year from now, just because we've got to factor in some, be a little bit conservative and give some likelihood that something could go wrong with one of those larger companies. The other side of this is market conditions are getting a little frothy in certain areas. Earnings growth expectations based on consensus numbers are 12% per year of growth every year for the next 3 years. That's double the long-term average. So we're seeing a lot of optimism from sell-side analysts. And then we're also, of course, seeing valuations starting to get back to where we saw in the early 2000s, depending on how you measure it, 22 to 24 times on the S&P 500. And again, it just comes back to this argument that if anything goes wrong, if we see any little blips, the market tends to sell those companies down pretty quickly, and if it's one of the big tech stocks, you can have a disproportionate impact on the index. So our base case is things are still going to evolve reasonably fairly. We're seeing positive earnings revisions across the market. If we get a couple central bank rate cuts as well, that certainly doesn't hurt. But I think that we would just be a little bit more cautious given all of the issues above.
When we think about those momentum players that have been leading the market, it's only been a couple days, but there was a bit of selling pressure on those. Are we seeing any rotation in the markets?
Little bits and pieces. What I would say, interestingly enough, the momentum, if you look at it quantitatively, it's a very slight decline. There have certainly been some bigger tech stocks, but on a broad basis, we're not seeing a huge rotation out of momentum. It's really a couple of AI-specific names. But what we have seen more of, and we're noticing this across our quantitative models, is there's been an uptick in demand for dividend yield and value stocks. Now, what's interesting is that's actually not just the last couple of weeks. It's been going on for 5 years. If you go back to November 2020, when we had the vaccine news, bottom of the market, a basket of value stocks has outperformed the S&P 500. I forget the exact number, but it's 10-15% over the last 5 years, which probably surprised people because AI and NVIDIA and all these other companies have been much more front and center. And we're starting to see that trade reaccelerate again, and particularly for dividend yield, now that we're seeing some central bank rate cuts in the U.S. come back on the table. Who knows if it's 1 or 2 or 4 or 5? That'll depend on how aggressive this rotation is and how long it continues. But as investors see some of those rate cuts coming in, you've got to replace that income somehow, and that makes dividend yield stocks a lot more attractive. So we've definitely started to see, maybe not outright selling of the high multiple stocks, but certainly starting to see investors being aware that they need to diversify away from a concentrated market. And it seems like value and dividend stocks are picking up a lot of that in the market over the last couple of weeks.
I hate to say it because it makes people angry at me, but here in Toronto, now. The C&E is on. Central bankers are gathering in Jackson Hole. We know summer doesn't have that much more life. At least a proper summer vacation before Labor Day. We all get in serious mode on the other side of Labor Day. Is it still a risk-on market?
What we've been seeing in our factor models is it is very much a risk-on market, and the way we would define that is by looking at high volatility stocks relative to low. We run that through a lot of our models to get a very clean sense of how the market is pricing those groups. And what we've been seeing for the last 5 years, and it's almost the same as value stocks, the market has had a very strong preference for higher risk, higher beta securities. Very unusual. If you look at the 40-year trend, all you had to do is buy boring, defensive, dividend-paying stocks. They tended to outperform with lower volatility. But the last 5 years, you're seeing a little more inflation concerns. That tends to help support some of the more cyclical areas, energy and materials in 2021, 2022, and inflation was heating up. Those were quite strong. And then people sometimes forget this, but the NVIDIAs and the AI stocks also tend to be higher beta relative to the broader benchmark. And so on this AI theme, we're also seeing that demand holding in. We really haven't seen, there's been blips. If you go back to April when we had the tariff war, very aggressive rotation into defensive stocks in a short period of time. But broadly speaking, we're right back up to sort of all-time highs in the last 5 years on risk on. Our main concern would be this thing seems to be changing very quickly. So if the tone shifts, if something happens that brings more concern into the market or more macro shocks, we had one of the biggest rotations into defensive stocks in April that we've seen in 25 years, and it happened in the space of a couple of weeks. So it's very important to get ahead of that, and we think it's a great time for investors to use the quiet of the summer to add a little diversification and make sure they've got portfolios that are resilient to all market environments.